Good morning again, and welcome to our video session, uh, video learning session. And today we will be discussing standard costing and variance analysis. Now, what is standards? Standards is a benchmark set by management in aid of performance measurement. So it can be likened into criteria or a requirement for you to choose between two alternatives. It's like if you have to choose between the two alternative, uh, the the choice that falls within your standards, that would be the one to be chosen out of the other. So standard is important for us to determine or make any decision. Now, in accounting, we also use standards for especially for manufacturing or producing goods or product. Now we have two kinds of standards here: quantity standards and cost standards. In quantity standards indicates the quantity of raw materials, uh, labor time required to produce a unit of product. This is normally expressed on a per unit of output. Uh, Normally, when we say quantity standards, this is based on the possible or the level of uh, inputs over the possible output. Kumbaga, this is the expected output out of the input. So, for example, for raw materials, uh, we normally say the standard quantity for raw materials is 3 pieces per unit of output. Or for labor, we will normally say we might incur 3 hours of labor time for every 1 unit of output. So basically, quantity standards is expressed on a per unit of output. Now, when we say cost standards, this indicates that the cost of quantity standards should be. This is normally expressed on a per unit of input. So, in contrast to quantity standard, when we say cost standards, we are putting criteria on the inputs to produce a certain product, say how much raw materials to be uh, used or pay to produce a certain unit, or how much labor are we going to pay to produce a certain unit. Now we have different base whenever we set standards. When we say ideal standards or theoretical standard, this is a standard set for an ideal or maximum level of operation. This theoretical standard or ideal standard, this does not take into consideration the uh, possible delays or breakdowns or any stoppage within the operation, like for example, uh, material shortage or wastage or brownouts, or maybe manpower shortage whenever there is a shortage of laborers, or any machine breakdown. So this standards is, or this base for setting a standard is like likened into a perfect condition of manufacturing. And this may produce a negative impact because it is impossible to achieve. So the laborers will be forced to perform their task at a high level without any considerations of their uh, being late, or they might get tired of working. While currently attainable standards is the practical base of setting standards, uh, is a normal standard set for a normal level of operation and efficiency, allowing expected or normal production problems such as machine breakdown, electricity outage, material shortage and wastage, and worker shortage. So this is the most commonly used type of standard because it creates positive effect on workers since it is more reasonable and more attainable. And it considers the uh, operation in a normal condition, meaning considering all other possible stoppage or uh, breakdowns in the normal course of operation. Okay, so that's how we set standards. Now, uh, when we set standards, we normally compare the standards to the actual, just like what we have learned in the factory overhead control and factory overhead applied. The factory overhead applied is the standard, and the factory overhead control is our actual cost. So normally we compare the actual versus the standards for us to arrive to the difference that should be investigated. So uh, the difference between the two is what we call variance, difference between the actual and the standard cost. So in short, the formula for computing the variance is total actual cost of actual input minus the standard cost of the actual output equals the total variance. Now, when we solve for variance, we have to interpret it as either favorable or unfavorable. We do not say it's negative or positive. Now, favorable variance is not necessarily associated as good, or unfavorable variance as a bad result. The determinations of good or bad must be made after identifying and analyzing the cause of the variance and its effect to other cost elements. Any variance, whether favorable or unfavorable, as long as it is significant in amount, should be investigated. So later on, we will uh, try to give some criteria on how to determine whether the variance is favorable or unfavorable. Again, it does not necessarily mean that when we say favorable, it is good, or unfavorable is bad. Now, the difference between the actual and standard, which is the total variance, is composed of two, or the result of two components: the price variance or the rate variance, and the quantity or usage or efficiency variance. The price or rate variance is the variance caused by the difference in price or in amount, or in cost, while the quantity or usage or efficiency variance is the variance caused by the difference in number of units or number of uh, hours consumed or incurred. Okay, so we will now start discussing variance on the different elements of production, and that is materials, labor, and overhead. For direct materials, we have, like what I've said, two elements of variance: materials and quantity variance. For material price variance, we have two kinds of material price variance: material purchase price variance and material usage price variance. Okay. Uh, the formula for material purchase price variance is actual quantity purchased multiplied by the actual purchase price less actual quantity purchased times the standard price. Or if you can see in the formula, there's a similar variable AQP. So we can simply deduct or get the difference between the actual price and the standard price and multiply it by the actual quantity purchased. Okay. Now in material usage price variance, the formula is actual quantity times the actual price less actual quantity times the standard price. So again, we have here uh, similar variables AQ. So we just simply get the difference between AP or actual price and standard price multiplied by the actual quantity. Now, what's the difference between material purchase price variance and material usage price variance? Material purchase price variance, the multiplier here is the actual quantity purchased, while here is the actual quantity used. This is different in uh, in a way that not all purchased quantity are used in the production. So this one, we are trying to get the variance on the quantity purchased, the variance caused by the price and the quantity purchased. Well, this one, we are trying to determine the price variance or the variance caused by the price on the actual quantity used in the production. Okay, now the other half of the total variance is material quantity variance, and its formula is actual quantity times the standard price minus standard quantity times this standard price. So here the similar variable is the standard price. So we simply get the difference between the actual quantity minus the standard quantity multiplied by the standard price. Okay, so in this formula, we're trying to solve uh, the cost of the difference in the quantity used to produce a product at the standard price. Now, the material quantity variance can be further analyzed using material mix variance, or sometimes they call it material blend variance, plus material yield variance. Normally, whenever we produce product, we do not just simply use one single raw materials. Normally, we use uh, several materials to produce a certain product. So there is a mixture of raw materials. So whenever there's a difference on the mixture uh, based on the standard and the actual, we will have a blend variance. So this is a mixture variance. Now the yield variance, sometimes when we set standards on input and we have an expected number of output, and the output does not conform with our expectations, we have a difference, or what we call yield variance. So yield variance is standard quantity less standard mix multiplied by the standard price. Now the total of these two variances is also equivalent to material quantity variance. Okay. I guess for you to easily memorize or understand this one, like I've said, material mix variance and material yield variance is also MQV. In the formula here, we have Sn minus AQ times the SP. SQ minus SM times the SP. So we have here same variable here. So if this is the same, what we will be left is SQ and AQ multiplied by SP. And that is the formula of the material quantity variance, AQ and SQ times the SP. Okay, let's move. So the journal entries for price variance. We have two kinds of journal entry because the determination of price variance could either be during at the time of purchase or at the time the materials are being transferred to the production area, or in short, during usage. So if the variance caused by price difference is determined at the time it was purchased, uh, the variance is already discovered at the time of purchase. The entry upon purchase is debit raw materials, and that is on the actual quantity purchased at the standard price, and then credit accounts payable, which is the actual quantity purchased times the actual price. So as you can see, there's a difference in the actual price and standard price. The debit to our raw materials inventory is at the standard price, while the accounts payable is at actual price. So the difference between the two is what we call material price variance. It's either unfavorable or favorable. So unfavorable materials price variance is debited, while favorable materials price variance is credited. Let us try to give some substitutions here so that we could better understand. Say the actual price, the actual cost using the actual price of our raw materials is 10 pesos, while the standard price is only 9 pesos. So we have here an unfavorable material price variance. Why unfavorable? Because we set it, or we benchmark it at 9 pesos. We set our standard in terms of price at 9 pesos, and yet we were able to pay it at 10 pesos, right? So we have a higher actual cost as compared to our standard price. And that is unfavorable because we have to pay more than the standard. So that is a debit to material price variance of unfavorable of 1 peso. Now, if the case is on the other way around, say we have an actual payment or accounts payable of, say, 9 pesos, and yet we set our standard at 10 pesos. Okay, so we set at 10 pesos and we were able to buy at only 9. That's favorable because we are paying less on our standard, and therefore we have a material price variance favorable of 1 peso. Okay, now just remember that the accounts payable is credited on the actual price on the actual quantity, while the raw materials inventory is debited on the actual quantity purchased at standard price. Now, when we use this raw materials in production upon use, the raw materials inventory to be credited is at standard price, actual quantity at the standard price. Okay, now when we use our raw materials, uh, the entry would have been debit work in process and credit raw materials, right? But our credit here in raw materials is the actual quantity used. But in our work in process, the debit should be on the standard quantity, meaning if we set to use, say, 10 units at 1 peso, 10 units at 1 peso, and yet we were able to use, I mean, that's the standard. And yet in actual, we only use, say, 9 units at 1 peso. So there's a difference between the quantity used. We used more than the standard. I mean, we use less than the standard. This is our standard. This is the actual. Right? So 10 and 9. So if we use less based on our standard, that is favorable on our part because we were able to save some units of raw materials. Again, say for example, our standard number of units to be used to produce 1 unit of product, say 10, that's the standard. And in actual, what we actually use is only 9. So we have a difference of 1 unit of raw materials, and that is favorable to us because we were able to use less than our standard. So that's material quantity variance, favorable, credit. Now, if we use more, say this is 10, we use more than our standards, than our standards. Say our standard is only 8, and yet we use more, actually, that is unfavorable on our part because we were able to consume more of our raw materials as compared to our standard. So that is unfavorable material quantity variance. Again, this journal entry will be used only if the price variance is determined at the time of purchase. Now, what if the the difference between the price was discovered only at the time of use? So upon purchase, we both record the raw materials inventory and the accounts payable on the actual price and actual quantity purchased. And then upon use, we discovered that the standard price for the raw materials inventory is either higher or lower than the actual price, then the variance on price will now be recognized on the entry upon use. The uh, material usage price variance, if it is unfavorable, debited. If it is favorable, then it's credited. Okay, so the same analysis, if it is discovered in during purchase and as well as in use, it's just that the entry for the variance is recorded during or upon use. The variance on relative to price is recorded during upon use. Okay, let's try some examples for us to better understand. Say Marie Corporation produces liquid dishwashing soap known as Linis. The direct materials for 1 unit of Linis is as follows. We have standard quantity per unit, 5 liters, meaning for every unit of Linis, we have to consume 5 liters. And this is the standard, the expected or the benchmark number of liters to be used to produce 1 unit of Linis. The standard price per liter is 15 pesos. So if it is 15 pesos per liter and we have to use 5 liters for every unit of Linis, how much is the standard cost per unit? That 15 times 5 liters, that's 75 pesos standard cost per unit, or the standard cost of raw materials per unit. Now, the actual quantity purchased is 12,000 liters. The actual cost of purchase is 15.50 per liter. The actual total quantity used is 9,500 liters. The total the total quantity produced is 2,000 units. So, out of the total actual quantity produced of 2,000 units, we were able to consume or use the total actual quantity of 9,500 liters. Now we have to compare the actual versus the standards. We will compute for the material usage price variance and material purchase price variance and material quantity variance. So formula for material usage price variance is actual price minus standard price times the actual quantity. The actual price is 15.50 and the standard price is 15 pesos. Multiplied by the actual quantity of 9,500, actual quantity used is 9,500. So we will arrive at 4,750. How are we going to know if this is favorable or unfavorable? This is the actual, this is the standard, so we pay more than the standard. So therefore, this is unfavorable. Okay, in terms of purchase price variance, the formula is actual price minus the standard price multiplied by the actual quantity purchased. So 12,000 units is the actual quantity purchased. The answer is 6,000. This is again unfavorable because the actual price is higher than the standard price of 15 pesos. That's unfavorable. Now, in terms of quantity variance, difference in quantity, actual quantity used, minus the standard quantity to be used, multiplied by the standard price. The actual quantity used is 9,500. The standard quantity is 10,000. How did we get 10,000? Let me go back to the previous slide. Our standard quantity per unit is 5 liters. For us to produce 1 unit, we have to consume 5 liters. That's the standard quantity inputs. Now, we were able to produce a total quantity of 2,000 units of linis. So, the standard quantity of raw materials that should have been consumed is 5 liters times 2,000 units. We should have consumed 10,000 units of, 10,000 liters of the raw materials. And yet, we only used 9,500 liters. Okay, so let me go back to the next slide. So the actual quantity is 9,500, but the standard should have been 10,000 multiplied by the standard price. So we have here a material quantity variance of 7,500, which is favorable because, again, we did not use uh, all of our standard quantity. We only used 9,500 liters. So we have a savings in terms of units of liters. Okay, now for the entry, say this is the entry the variance was discovered at the time of usage. Again, we record our purchase at the actual price multiplied by the actual quantity purchased. So 186,000. Debit raw materials, credit accounts payable, 186. Now, upon use, that's the time we were able to discover the difference in price and the difference in quantity used. So the entry would be debit work in process at the standard price at standard quantity of input, that's 150. Debit material usage price variance of 4,750 as we have computed, unfavorable, so therefore debit. And then credit material quantity variance, since this is favorable, this is credit. And then we credit our raw materials based on actual price multiplied by the actual quantity used. That's 147,250. Actual price, actual quantity. Upon purchase, because since we record the raw materials at actual price and actual quantity, we also use this one when we credit this raw materials inventory account. Now, as you can see, there is no entry on the material purchase price variance. Why? Because the variance in terms of price is discovered at the time of usage. So we use material usage price variance. Now, if the price variance is discovered at the time of purchase, this will be the entry. Debit raw materials, standard price at actual quantity purchased, debit 180,000, and then debit material price variance, purchase price variance of 6,000, that's unfavorable, and then credit actual price at the actual quantity, 186. Okay, for the quantity variance, debit work in process, debit material quantity variance, unfavorable. Oops, hold on. This is an error. Material quantity variance favorable of 7,500 should be credited, and then credit raw materials inventory 15 pesos times 9,500. Let me just correct this one so that we will not be confused. This should be credited. Oops. And this is not unfavorable. This is favorable. Okay. So upon use, debit work in process 150, credit material quantity variance favorable 75, and then credit raw materials inventory 142,500. Oh, I see. In your book, on page 556, that's an error also. That should have been material quantity variance favorable of 7,500, and it should have been credited, not debited. Okay. Now let us now try material mix variance and material yield variance. So for example, Marie Corporations combines three types of materials to produce its product. For a 100 kilo batch, the standard cost for materials are as follows. Material X, we are uh, we are to use 60 kilos for every 100 kilo batch. For every 100 kilo of uh, in a batch of 100 kilo. So 60 kilos. So the standard price for each kilo is 5 pesos. So that's equivalent to 300 pesos. For material Y, 36 kilos, 4 pesos per kilo, that's 144 pesos. Material Z, 24 at 3 pesos, 72 for 24 kilos. For a total of 516 pesos for every 100 kilo of a batch. During the month of February, the company produced 200 batches or 20,000 kilos of its product. Okay. Uh, we have 200 batches. For every batch, we will consume or we will produce 100 kilo of per batch. So if it is per batch 100 kilo and this is 200 batch, we have to simply multiply 100 kilo times 200 batches. That's 20,000 kilos of its product. So, the actual materials used to produce the 20,000 kilos of its product, or ensure the 200 batch, uh, we were we consume 12,600 kilos at 4.8, or 60,480. For material Y, 7,300 at 4.10, that's 29,930. 4,700 kilos at 3.40, that's 15,980, or a total of 106,390 pesos. for the production of the 20,000 kilos or 200 batches. Now, let us now compute for the material mix variance and the material yield variance. Formula: standard mix minus the actual quantity multiplied by the standard price for the mix. Okay, so for the mix, where did we get 50, 30, and 20? Let me go back to our previous slide. Okay, so as you can see, in order to produce a batch of our product, which is equivalent to 100 kilo, we have to consume 60 kilos of X, or in the total combination, that is 50%, 60 over 120. Okay, for material Y, we have to consume 36 out of 120 kilos, and that is 30%. And then material Z, the standard units is 24 out of 120, that's 20%. So this is the standard mixture of material X, Y, and Z, 50, 30, and 20%. Okay, so that is where we get 50, 30, and 20. Now, where did we get 24,600? Okay, the actual quantity used, the total quantity of the raw materials is 24,600. From this actual total kilos consumed to produce the 20,000 kilos or 200 batch, 50% of this should have been used for X. 30% of 24,600 should have been used by Y. 24,600, 20% of this should have been used for the material Z, right? So this is the actual quantity. So if we get 50, 30, and 20, that's the standard mix. That's the standard mix. Multiplied by the standard price, we deduct this to our actual quantity at standard price. Okay, so we do it on a per material basis. For material X, okay, we have a negative 1,500, meaning we consume more than the standard, because 50% of 24,600 is only 12,300, and yet we actually consume 12,600. So we consume more than the standard. So that's unfavorable of 1,500 pesos. For material Y, this is positive, this is favorable because we consume less than the standard. The same with material Z, this is favorable. But of course, we have to compute the total material mix variance. So 1,5, negative 1,5 plus positive 320 and 660, we have negative 520. So in total, we actually used more than the standard. So therefore, this is unfavorable of 520 pesos. Okay, in terms of output, the yield, the formula is standard quantity multiplied by standard mix. Oh, sorry, this is not multiply. Let me just correct this one. Oops. Okay. Standard quantity less standard mix multiplied by the standard price. Okay, so I guess we are all clear on the standard mixture 50, 30, and 20 multiplied by standard quantity. Where did we get 24,000? 24,000 is the actual quantity of the raw materials consumed, right? But where did we get 24? Let me go back to our previous slide. Okay, now based on our standards, we have to use 120 kilos for every 100 kilo batch. Okay, now if we were able to produce 200 batches, that's 120 times 200, right? And that is 24,000. Again, this is our standard quantity for our standard output of 100 kilo batch. So if we were able to produce 200 batches, that's 120 times 200, we should have uh, actually produced 24,000 uh, kilos of a 200 for 200 batches. Okay, so that's where we get the 24,000. The standard multiplied by the actual output equals the standard quantity. That's 34,000. So get the difference again. Uh, the answers are all negative. Let me just analyze this one for you. Mm, this is the standard mixture multiplied by the standard output less the standard mixture multiplied by the actual output. Okay, so uh, more we have more standard uh, mixtures here. We were able to consume, I mean, out of the 24,600, which is the total of the raw materials, 50% of which uh, is allotted to material X. Okay, that's the standard mixture. But as we compared it to our standard quantity that should have been used is only 24,000. So we have more than the uh, should have been. Again, the total number of uh, kilos that should have been consumed to produce a 200 batches is only 24. And yet the actual number of kilos that was used to produce a 200 batches is 24,600. So we used more than the standard. That's why this is unfavorable on our part because we used more than the standard. Okay, let me just recharge my laptop. Now let's go to the entries. Now when we do an entry for material mix and material yield, this is always discovered only upon use, not upon purchase. So the entry would have been debit work in process 103,200, credit raw materials inventory of 106,390. Okay, where did we get all these figures? Mm, there's no separate variance for material mix and material yield. Again, the total of the two is the material quantity variance. So this is 520 and 2580. So this one is 3,100 material quantity variance. And this is both unfavorable. So this is debit material quantity variance 3,100. Now, where did we get 103, 290, and 106,390? If we will compute for the material usage price variance, we will get the 90 pesos. Let me just go back to the previous slide because we have difference in price. Okay, so compute for the materials usage price variance and you will get uh, the 90 pesos. Now, how about the 103 and 103,200 and 106,390? The 106,390, since this is upon usage, we record the materials inventory upon purchase on the actual price on the actual quantity. So therefore, the materials inventory, when we issue it to our production, we will use actual quantity at the actual price. So the actual price is 4.8, 4.10, and 3.40. The actual quantity is 12, 6, 7, 3, and 4, 7. So in short, the total raw materials credited is 106,390. Again, why did we use actual price and actual quantity? Because the variance is discovered upon use. So the credit for raw materials is the actual price at the actual quantity. But how about 103,200? This is standard mix at standard quantity multiplied by the standard price. Where are we going to get that? This is the standard mix, this is the standard quantity, and this is the standard price. So you just get the product of all these three raw materials, you will arrive at 103,200. Again, we debit our work in process on the standard quantity at standard price. Okay, that's it for materials. We now go to labor. Uh, for labor, we don't have labor purchase rate variance or labor usage rate variance, simply labor rate variance because we don't normally purchase labor and put it on inventory. So uh, labor rate is the difference between rates, that's the actual rate minus the standard rate multiplied by the actual time. For labor efficiency variance, for material, we use material quantity variance, but for labor, since this is an effort being rendered, a service being rendered, we use the word efficiency. So labor efficiency variance is the difference in time multiplied by the standard rate. Okay, so same as materials, it has labor mix variance and labor yield variance. The total of the two, again, is the labor efficiency variance. Journal entry, debit, work in process, again, standard at standard time at standard rate. The credit is actual time at the actual rate. The difference between the two, unfavorables are debit, favorables are credited. Okay, let's go to the example. Maricorp produces liquid dishwashing soap known as Linis. The direct, this one is labor. Let me just correct this one. Okay, the direct labor for 1 unit of Linis is as follows. Standard hours per unit is 2 hours. The standard rate is 20 pesos per hour. The standard cost, therefore, is 40. So for every unit, we will consume 2 hours. And at 20 pesos, that's 40 pesos. Now, the actual total labor cost is 81,900. The actual total hours used is 3,900. The actual quantity produced is 2,000 units. So let's compute for the labor rate variance and labor efficiency variance. Difference in rate multiplied by the actual time. So the standard rate is 20 pesos. Now we have to get the actual rate. That's 81,900 divided by 3,900. Where did we get this one? We actually paid a labor cost of 81,900 and the actual hours used is 3,900. So to get the actual labor rate, you just simply divide 81,900 by 3,900 to get the actual labor rate. Deduct it from the standard rate multiplied by the actual time, we get 3,900. And this is unfavorable because 81,900 over 39 is 21. So we pay higher than the standard. So we get 3,900. That's unfavorable on our part. Now for the labor efficiency variance, the difference in time multiplied by the standard rate, the actual time consumed to produce the product is 3,900. The standard time is 2 hours per unit multiplied by 2,000 units. We have 4,000 hours multiplied by 20. That's 2,000 pesos. Okay, so this is favorable. Why? Because we actually used 3,900 hours. That should have been 4,000. So nakatipid tayo dito. We have a savings in terms of time. We only pay 3,900 and we should have been paying 4,000 hours. So this is favorable. Let me just make some corrections here. I know I understand this should have been negative. Okay. So as you can see, not all negatives are favorable and not all positives are unfavorable. Okay, so entries, debit, work in process, standards at standard, standard hours at standard rate, 80,000. Credit, wage payable, actual hours, actual rate, 81,900. The labor rate variance is unfavorable, so debit, 3,900. The labor efficiency variance is favorable, that's credit, 2,000. Okay, let's go to the labor mix and labor yield variance. Following information is available from Marie Corp. The standard labor hours for 1 unit. For skilled workers, we have 5 hours at 50 pesos per hour. So as you can see, we have here some mixtures of skilled and unskilled workers. For skilled, the standard should have been 5 at 50. For unskilled, that's 15 at 30, or a total of 700. Now, the 20 units of finished products have been actually produced during the period with the actual labor hours used and labor rate as follows. For the skills, for the skilled, the actual hours consumed is 90 at 48, and unskilled is 320 at 32. Hold on. I think I have another error here. Hmm. Okay, I think. Oops. This part should have not been written here. Kindly correct also your the copy on your book. So this is unskilled workers. The actual hours consumed is 320 at a rate of 32. Okay, let's now compute for the labor mix and the labor yield variance. Labor mix is standard mix less actual time. Again, where did we get 25 and 75? The mixture of the two, 5 and 15 hours. Okay, 5 and 15. So this one is 25%, this is 75%. So 25 and 75 multiplied by 410. Where did we get 410? The actual hours consumed. So out of 410, 25% of that should have been for skilled workers and 75% should have been to unskilled. But the total actual hours is 90 and 320. Okay, 90 and 320. Multiplied by the standard rates, we have here our variance. Okay, so for the skilled workers, we actually incurred 90 hours, but based on our standard, it should have been only 100, I mean, it should be 102.50 hours. So if this is the standard, 102, and this is the actual, we have a savings of 625 pesos. Why? Because uh, they should have been working for 102.5 hours, and yet they were able to finish the production within 90 hours. So we pay less. Or we have a savings of 625 as compared to unskilled workers. They actually work for 320, but 75% of 410 is 307. They should have finished the production within 307.5 hours, and yet they incurred 320. This is unfavorable. So we pay more for unskilled workers of 375. So adding the two, we have a greater favorable standard rate variance of 250. So same here in the yield, you get the mixture multiplied by the standard hours for 1 unit multiplied by the total actual output versus the uh, mixture at actual hours. So we have here an unfavorable variance of 350. Okay, why is it unfavorable? This is the actual hours, and uh, 25% of 410 is 102.5, while 25% of the 400 is only 100. So in the actual number of hours, 100, yun nga yun, 102.5 uh, was supposed to be used for the skilled, supposed to be incurred by the skilled workers. But based on our standard hours, that should have been only 100. So the output based on the mixture consumes more, and that is unfavorable. Okay, 125 and 225. So a total of unfavorable of 350. So debit work in process at standard rate, standard time, 14. Wage payable is actual. Oops, we have here some error again. Let me just check this one. Yes. So the total labor efficiency variance is only unfavorable of 100. That's 250, and unfavorable of 350. That's unfavorable of 100. So where did we get labor rate variance? So you just simply use the formula to arrive at the labor rate variance of 460. But the labor mix and the labor yield, you simply add uh, for you to arrive at the labor efficiency variance of unfavorable of 100. Okay, let's go to factory overhead. We have here 5 ways of analyzing the variance for factory overhead. 1 way, 2 way, 3 way, 4 way, and 5 way. But we will only discuss 2 way, 3 way, 4 way analysis. 1 way is we are done with 1 way analysis actually when we discuss accounting for factory overhead variance. That is the difference between your applied factory overhead and your control factory overhead control account. It is under over applied or under applied. That's 1 way analysis. The 5 way analysis is for your higher accounting. At least we will save one more topic for you to be excited for the next higher accounting. So uh, we will discuss only 2 way, 3 way, and 4 way. Okay, let me just go back to this uh, classifications of FOH. Factory overhead could either be variable and fixed. I think you know already what is fixed and variable. So factory overhead could either be fixed and variable. Now, for 2 way analysis, uh, we call it 2 way because we are computing for two kinds of variance under factory overhead. That is controllable variance and volume variance. Controllable variance is the difference between the actual factory overhead cost and the budgeted allowance based on standard hours. So the code here is AFO, actual factory overhead, and budgeted allowance based on standard hours, BASH, budgeted allowance based on standard hours, that's BASH. So if AFO is greater than BASH, that's unfavorable, simply because actual is higher than the BASH, right? Actual cost is higher, so that's unfavorable. So AFO less than BASH is favorable. Now for volume variance, this is the difference between your BASH and the standard cost, the standard hours at standard rate or share, BASH share. If BASH is greater than your share or standard hours at standard rate, that's unfavorable. So in reverse, that's favorable. Okay, let's continue this one. How do we compute? Again, simply get the difference. Actual overhead, get the fixed and the variable, add them up, that's the actual overhead. Less your budgeted allowance on standard hours. We also have two kinds, fixed and standard, fixed and variable. So as you can see, the fixed factory overhead, since this is a budgeted allowance, the budgeted allowance is on a fixed overhead is normally at uh, normal capacity times the standard fixed rate. Normal capacity and the standard hours is actually different. Okay, because how can I explain this one? The normal capacity is the practical output on the space. Say, for example, we have a 100 square meter of uh, workstation or production area. And this 100 square meter could actually produce normally 20,000 units. That's the normal capacity. But standard capacity or standard hours used for computing the standard variable factory overhead is different from the normal capacity. Say, for example, the standard hours is, say, 20, two hours per unit, and we were able to produce, say, 3,000. So the standard variable factory overhead, 2 hours times 6,000, that's 12,000 hours, is different from the normal capacity of, say, the normal capacity of, say, 10,000. Okay, since why is it different? Because the other one is fixed, regardless of the numbers of output, we still have to pay it fixed. So therefore, that is based on the normal capacity, while variable is based on the number of output. So therefore, there's a difference between the normal capacity and the standard hours. Okay, so just add the two budgeted allowance, we will get controllable variance. For volume variance, get uh, the total that we have computed on bash, less it to or deduct the standard factory overhead cost. This time, as you can see, we will now use the standard hours multiplied by standard fixed rate. As you can see, we have a different multiplier here, normal capacity and standard hours. This is what I'm telling you. Standard hours and normal capacity is different from each other. So we will get a volume variance. Okay, three-way analysis, spending variance, efficiency variance, and volume variance. So with volume variance, we already understand this one. This is bash less share. Now, spending and efficiency variance. Spending is the difference between the actual factory overhead cost less the budgeted allowance based on actual hours, not standard hours as compared to standard hours. In two-way analysis, that's bash. This one is BAA. So if AFO is greater than BAA, that's unfavorable. Now for the efficiency, actual hours worked at standard rate less standard hours at actual production at standard rate. So standard hours at standard rate in short. So ASAR is greater than CSHARE, that's unfavorable. Actual hours at standard rate less standard hours at standard rate. Okay, let me show you the formula. Actual factory overhead, AFO, less BAA, budget allowance on actual hours, normal capacity at fixed rate. This one, standard variable factory overhead, that's actual hours multiplied by standard variable rate. Okay, so this one is the same from the two-way analysis. Fixed factory overhead budget is the same in two-way analysis. This one is different, actual hours. So actual hours less the standard. So in efficiency variance, we are actually getting the difference between the standard variable factory overhead. Now for volume variance, we are actually getting the difference between the fixed factory overhead. Okay. Now for four-way analysis, we have fixed spending, variable spending, and then efficiency and volume variance. So actual factory overhead less your budgeted fixed overhead, and then for variable we have the variable factory overhead and the variable budgeted overhead. Okay, so actually it's just an expansion of the three-way analysis. We just have to compute separately the fixed and the variable spending. So the fixed spending, actual fixed minus the fixed factory overhead, variable spending, actual variable less the standard variable overhead based on actual hours. And then we go for efficiency in the volume variance, which is similar to three-way analysis. The volume variance is the same as in two-way analysis. Okay, let us now go to the disposition of the standard cost variance. This is the same on the factory overhead. I mean, accounting for factory overhead that we learned already, that if the variance is significant, it will be allocated to the ending balance. If it is insignificant, then close it to the cost of goods sold. All those entries that we had in the previous slide, material quantity variance, labor rate variance, overhead variance, all the variances, if it is insignificant, close it to the cost of goods sold. If it is significant, then we have to allocate to cost of goods sold, finished goods, and work in process. So just take note of the entries for favorable and unfavorable variance. Okay, let's go now to the example of the factory overhead variance. The following are the standard cost data of Paul Corporation for the month of January. Each unit of chairs requires 0.50 hours of labor time to produce. The variable factory overhead is 10 pesos per labor hours. The fixed factory overhead is applied at the rate of 5 pesos per labor hour based on the actual or based on the expected annual capacity of 25 hours. That is the normal capacity. Okay, the number of chairs produced is 52,000. The actual numbers of hours is 26,500. The variable factory overhead actually consumed is or incurred is 270,000 peso. The fixed cost incurred is 140,000 pesos. Okay, two-way analysis. Actual fixed, actual variable, that's 140 and 270. You may have missed this one, but this one is the actual 270 and 140. Okay, and then the budgeted allowance based on standard. Again, the fixed cost is based on the normal capacity of 25,000 hours. We just go back 25,000, the normal capacity at 5 pesos. That's the standard rate, 5 pesos. And then the standard variable fixed factory overhead. The standard variable factory overhead is 52 units at 50.50 hours, or in short, 26,000 hours at 10 pesos. Let me just show you the standard variable factory overhead. That's 10 pesos. That's the rate. 50.50 hours. Since we produced 52,000 units at 26,500, okay, 52 units times 0.50 times 10. Okay, That's 260. So the difference between the two is controllable variance of 25,000. That's unfavorable because AFO is greater than the BASH. For volume, standard fix, 52 units at 0.50, or in short, 26,000 hours. This one, as you can see, if we compare it to the normal capacity versus the standard hours, we have here a difference of 1,000 hours. That is what I'm saying, that normally fixed cost is based on the normal capacity, but sometimes, when we apply to the standard, we will now have a difference in terms of hours. So zero point 0.5 times 5 pesos, that's 130. Standard variable, copy and paste, 260. So we have 390. 385 versus 390. Bash is less than the standard FOH. We have 5,000 favorable. Three-way analysis, actual, okay. Budgeted allowance based on actual hours, 26.5. Normal capacity, okay. So we have a spending variance of 20,000. Budgeted allowance based on standard hours, sorry for that. Okay, so as you can see, we are only getting the difference between the standard variables. Efficiency of 5,000. And then for volume variance, we know this already, 5,000 units, 5,000 peso. Now, for the four-way, we just simply divide this 20,000 into a fixed and variable. For the efficiency and volume, it's just the same, 5,000, 5,000. Okay, for the spending, the fixed spending variance is 15,000. The variable spending is 5,000. Okay, now how much is the total variance for this factory overhead? We have 15,000 unfavorable, 5,000 unfavorable, 5,000 unfavorable, that's already 25,000, less favorable of 5,000. So we have a total of 20,000 variance unfavorable for factory overhead. Let me just go back to our previous slides. For two-way analysis, as you can see, 25,000 unfavorable and favorable of volume variance of 5,000. We have 20,000 unfavorable. We have the same amount of unfavorable variance in using either two-way, three-way, and four-way analysis. Okay, I think that's the end for the standard costing and variance analysis. I know it's too long, it's too heavy, I think. Sorry for the uh, disruptions. Keep on learning, keep on watching, and keep yourself healthy. Thank you and good day to everyone.